Good afternoon and welcome to our Nonprofit Accounting and Tax Update webinar. I'm Donella Wilson, Nonprofit Practice Leader at GHJ, and I'll be moderating today's panel discussion. Joining me are my colleagues Liz Navarez, Yulia Mizerva, and Mark Kawauchi. We are all passionate about serving the nonprofit community, and we work exclusively in this sector. Liz leads our nonprofit tax practice, and Yulia and Mark are our technical experts on the accounting side. Full bios are available on our website and in the materials that will be sent out after today's webinar, along with the recording. We're going to be covering a range of topics today, as noted in the agenda on the screen. And our intention is to focus on questions that we ourselves have had, as well as questions that our clients have raised. Our goal is both to provide guidance as well as provoke discussion beyond today's webinar. We're going to start with certain provisions of the CARES Act and the American Rescue Plan Act, specifically the Paycheck Protection Program, PPP loan, and the Employee Retention Credits. Mark, can you remind us of the options for accounting for the PPP loan?
Yes, thanks, Danella. For nonprofit organizations, there were two accounting policies to select from. The first was the debt model under topic 470, which was the guidance for debt. And the second was grant model under ASU 2018-08, which was the accounting guidance related to contributions. And under the debt model, nonprofit organizations would recognize forgiveness in the period they were legally released from the obligation. So for PPP loans, when the SBA approved forgiveness, that would be the period that the forgiveness would be recognized. Under the grant model, it's a little bit more complex. Since the PPP loan includes both barriers as well as a right of return, the PPP loan would be classified as conditional contribution. Forgiveness would then be recognized when the conditions/barriers are satisfied. So that period could be a different period from when you actually incur the related allowable expenses. So when you look at the two models, the major difference is the timing of recognition of the gain from forgiveness. So when we reflect back on how confusing the PPP loan process was, from starting with day one on the application process, the constant changing of the guidance, for June 30 year ends, the election of the accounting policy was sooner than it was required to be elected sooner than for December 31 year ends. The debt model was very clear on when forgiveness was going to be recognized, and most nonprofit organizations, they were very familiar with this accounting policy already. Under ASU 2018-08, the accounting guidance was a little bit not as clear, a little bit of gray. There are many discussions regarding what would be considered a barrier. If you received a grant greater than $2 million, if there was uncertainty during the application process, would the audit by the SBA be considered a barrier? So there's a lot of questions out there on the timing of recognition related to some of the uncertainties of what would be classified as a barrier. As a result, we saw most nonprofit organizations elect the debt model originally, back especially for June 30 year ends, because of just some of the uncertainty and just the confusion of the overall PPP process.
And so now, are you finding nonprofits changing their minds with the slowdown in the loan review decisions by the SBA? Is there a change of heart, as there's a chance that forgiveness may not be received, especially for those June 30 year ends that you mentioned mostly took advantage of the debt model?
Yeah, great question, Danella. So when we fast forward to today, many organizations with larger PPP loans are still awaiting forgiveness from approval from the SBA. And if you're a June 30 year end, we are now in May, and we're coming close to year end June 30th, 2021. With that forgiveness still uncertain of when it's going to be received. We have heard from a few nonprofit organizations that they are not going back and rethinking whether the grant model should have been adopted originally. And I think some of the delays in the forgiveness approval kind of pushed that consideration. But for because if you think about if you're a June 30 year end, the related expenses that you've incurred that's going to be applied towards forgiveness, took place both in fiscal year 2020 and 2021, but under the grant model, the forgiveness will not be recognized until fiscal year 2022. So you look at a very long period in different years of when the expenses were incurred and the related forgiveness is going to be now accounted for. And there's pretty significant timing difference between the incurring of expenses and the recognition. However, if you do elect to make some changes in your accounting policy, there are some considerations you need to evaluate before changing your accounting policy. There could be an impact on previously issued financial statements for June 30 year ends. With a portion of the payroll expenses and other expenses being incurred in fiscal year 2020, under the grant model, a portion of the forgiveness should also be recognized during fiscal year 2020. So an evaluation will need to be made to determine how material that amount is and whether it would have an impact on those previously issued financial statements.
So lots of considerations if you are going to consider changing your accounting policy, and a lot more work all around, I guess.
Correct.
Message there, but it is an option. Then turning to the tax side now, Liz, how will the PPP forgiveness be treated on the Form 990?
So the IRS actually has issued guidance. It's actually interesting that they included it within the instructions of the Form 990. Normally we see guidance in notices issued by them on how to treat these type of circumstances, but they have informed everyone that forgiveness of the debt will count as a government grant on the Form 990, so we will count it as a contribution, and it actually will positively impact your public support test on your Schedule A. So it's very easy in terms of the treatment on the Form 990.
Oh, wonderful. At least one side is easy, right? At least the tax side is easy and a positive result. Staying with the tax, and a slide is about to come up on the screen with quite a bit of detail, but Liz is going to make some comments on that now. Liz, switching gears now to the employee retention credits, can you give us a quick reminder of what that is, and specifically how to assess eligibility and how to claim the employee retention credit?
Yes, of course. So the employee retention credit was actually available in 2020 and was extended into 2021. So this was a credit that organizations are able to take against their payroll for qualified wages that they are paying. So these are payroll costs that they are incurring. They actually did make changes to the 2021 qualifications where it is actually more favorable in order to get the credit. You can actually see on the slide a brief summary. So in 2020, there was a 50% gross receipts decline, where in 2021, there only has to be a 20% gross receipts decline when you're comparing quarter to quarter. As well, you would qualify for this credit if there was a mandatory shutdown due to government guidelines. In terms of the qualified wages, again, that also increased in the 2020 year. Only 50% of qualified wages would be accounted for, and in 2021 it actually increased to 70% of qualified wages. So you're able to capture more of those payroll costs within the credit. The credit itself, again, it is a lot more favorable. 2020, they were allowing only $5,000 for the whole year. And now for 2021, it's actually $7,000 per quarter. So very advantageous. And organizations are actually going back into 2020 to see if there were any payroll costs outside of the PPP loan, because you can double dip, to check to see whether they actually qualify for this credit for those wages that were incurred and not covered through the PPP loan. And you do have the option of going back and amending your payroll form. So this is the 941X amendment, and that's how you would go back and claim this credit if you are eligible for that 2020. But again, I encourage everyone to see if either 2020 or 2021, you can claim this credit against your payroll taxes.
Yes, thanks, Liz. A very advantageous credit. And while you can't double dip with the PPP, outside of the covered period, as Liz mentioned, there could be some opportunities. So it's definitely worth checking out to see if you are eligible and whether you can claim this credit. Now, Yulia, switching gears to the accounting side, what does this credit look like on a nonprofit's financial statements? How is it presented?
That's a great question, Danella. Intuitively, one might think that the credit should be netted against related expenses, as it effectively reduces the employer's payroll tax liability. And this treatment is actually in line with the IFRS standard IAS 20, accounting for government grants, and several publicly traded companies have presented it that way. However, for nonprofit organizations, we believe the most appropriate treatment is to follow AS 605, accounting for government for grants and contributions. Under the standard, the credit would actually be considered a conditional government grant, and the revenue would be recognized when the conditions are substantially met. Now, when that revenue is recognized, the nonprofit would present it then on the statement of activities on a gross basis in the income section, and then your expenses would be also presented on a gross basis in the statement of functional expenses. And that way, your expenses would be comparatively similar, or would present a true picture of expenses for the current year.
Yeah, I think that's a very good point, right? Having the comparability for the on the compensation side in the functional expenses. Yes, thank you very much. I think you're right. Intuitively, one would think that it would go against the payroll tax expense, but as Julia said, follow the grant recognition guidelines for nonprofit organizations. We're going to launch a polling question for those of you who are wanting CPE. You'll have to complete, yes, here's the polling question. And it's following on from what Liz just spoke about, the employer retention credits, whether you've assessed for eligibility. So we'll give you a moment to respond to that before we switch gears into new accounting standards. All right, well, while that is busily being processed, we'll switch gears then to accounting standards. So Julia, the new accounting standard ASU 2020-07, the presentation and disclosures by not-for-profit entities for contributed non-financial assets, has a very deceptive title, as we have been discovering as we've been diving into it. Can you elaborate on what is in scope for this standard?
Of course, not only it's a mouthful of a title, it's also deceptive. When you go back to the, and there has been some confusion over what exactly falls within the scope of the standard. And when you go back and read the definition of what's included, it includes all types of non-financial assets that are contributed to the organization. So it's your fixed assets, materials, supplies, use of fixed assets and utilities, intangible assets, and even services. And it also includes unconditional promises to give those items. Now, the standard does exclude contributed securities and other financial assets that are readily convertible into cash.
And what about the disclosure requirements? Because now we've got a lot more categories, you know, quite a number of services as well as the assets. What about the disclosure requirements? And also if you could just touch on when it's effective.
Sure. So the most important disclosure requirement under the standard is presenting those contributed non-financial assets as a separate line item in your statement of activities, apart from other contributions. The other disclosure requirements are quite extensive, as Danella mentioned. First of all, the nonprofit has to present its policy on whether those contributed non-financial assets are sold or used in activities and programs. And then disaggregated information has to be presented over what types of non-financial assets were received, how they were used or were they sold, what programs and activities were impacted by utilizing those non-financial assets, as well as what valuation inputs were utilized in valuing those contributions. The standard is effective for nonprofit organizations for annual periods beginning after June 15, 2021. Now that means for all calendar year 2022, and then fiscal years June 2022 and onward. Early application is permitted, but it has to be retrospective. So if you are segregating those types of contributions on your statement of activities, you have to adjust the prior year numbers as well.
And presumably then, if you're presenting full comparative footnotes, you would have to have those disclosures there as well. Although I think most nonprofits tend to tend to produce just the single year comparative footnotes, even with the numbers portion being comparative. So, all right, so some more disclosures to prepare for. And Liz, on the tax side, how do these types of in-kinds show up on the Form 990? Because we know there's some differences there.
There is. In terms of in-kind goods, those actually are included in the Form 990 as both revenue and expenses. So we do include that. But for in-kind services and use of facilities or assets, we normally do back that out from the Form 990. It's not considered revenue for tax purposes. And there are specific guidelines and instructions. For example, any advertising space or advertising services, PSAs, those are not counted within the Form 990 and are required to be removed.
Thank you, Liz. So something for everyone to pay attention to. I think most probably know that there are differences between the Form 990 and the GAP presentation, but now we've just heard confirmation of that, particularly when it comes to advertising. It's a good reminder of those PSAs and billboards. Now switching gears to the lease standard, which of course has been the subject of many webinars and articles. I think we're all probably a little tired of the lease standard, and it hasn't even become effective yet for a number of organizations with the various extensions. But Mark, what are some of the considerations from a lessor's perspective that may not be on the radar for nonprofit organizations?
Yeah, I think most of us on this webinar, including myself, were hoping that topic 842 would magically go away and we wouldn't have to implement this standard. But unfortunately, this guidance is here to stay. If you think about, from a FASB and SEC standpoint, they introduced this topic back in 2005. So it's been around for many, many years. There's been a lot of time and effort that was invested in developing and implementing the topic 842 standard. As Danelle had mentioned, the FASB did defer the effective date back mid last year for private nonprofit organizations. So the effective date is now for fiscal years beginning after December 15th, 2021, meaning for a June 30 year end, the effective date is for June 30th, 2023. Now for lessor account, the accounting treatment for lessors is different from lessees. And again, the lessors is more of a revenue recognition and things that you need to consider as you go through, and as nonprofit organizations have any type of rental agreements, meaning that if you rent any space in your buildings or allow organizations or companies to rent your facilities or campgrounds to hold events, these would fall under topic 842. And for example, our firm rents out space over at UCLA to hold an annual audit and advisory update meeting that we have. And we have a lease agreement with UCLA to lease space for as well as some non-lease components, meaning food, setup, technical support, and they're all embedded into our agreement. And that's how most agreements under for renting of facilities take place. But you are required to evaluate each of the components to determine whether they fall under 842 or topic 606. So if you think about the different components, there's a lease component and there's a non-lease component to this transaction. And the lease components would fall under 842 and the non-lease components would fall under 606. Now, topic 842 does provide a practical expedient that can be used and considered that would combine both the lease component and the non-lease component together as a single performance obligation, meaning that you wouldn't have to go through and evaluate each component separately. You can combine it together and have it as one single performance obligation and evaluate whether it would fall under topic 842 or 606 based on that one single performance obligation. But in order to implement and adopt the practical expedient, there are a couple of criteria that need to be considered and needs to be met in order to fall under this practical expedient. The first is the timing and pattern of the transfer of the lease and the non-lease component need to be concurrently at the same time. The second is that the lease component would be classified as an operating lease. So if both of those criteria are met, then the two components could be combined and a single performance obligation would be considered at that point. Now, you still have to go through the evaluation to determine is it under topic 842 or 606, but you don't have separate components here that you need to look at. And typically most transactions would fall under topic 842, but there are some exceptions where if the single obligation is the let me restate that. If the single obligation is predominantly a non-lease component, then it would fall under topic 606. So if the lease is just like a secondary piece of the overall agreement, so the renting of the property or the floor, then it would fall under topic 606. Otherwise, if the lease of that asset or space is a predominant component, then it would fall under topic 842. So some considerations you need to make. But the practical expedient, I think, does allow organizations to go through and to combine the obligation or the components under one obligation. It makes the evaluation a little easier.
So a takeaway from that is that there's quite a bit to consider that a lessor that may not even think about themselves as being in that sort of business of renting out.
Right.
We'll need to really spend a bit of time just making sure the revenue streams are understood clearly, the different components that you have spoken about. And why this is important, because the revenue recognition patterns could potentially be different along with different disclosures. So this is definitely something to really focus on, especially if you have something a little bit more than just a trivial revenue stream from those items.
Right.
Right, so lots to think about on the lessor side. So Mark, what about some best practices for lessees? Really, I think for all nonprofit organizations that maybe haven't early adopted the standard, because almost every one of our clients anyway rents some form of office space at least. So what about some of the best practices for lessees as they start preparing for implementation of the standard?
Yeah, sure. So, as a refresher, that for lessee accounting, the ASC does require all operating leases, which are the off-balance sheet financing, to be accounted for and recorded on the balance sheets or statement finance positions of nonprofit organizations. And you would record both a right to use asset and a corresponding liability. And various nonprofit organizations have adopted this, and some have actually really adopted this as well. And some key takeaways that we've seen from some of our clients and some of the other non-clients as they went through and adopted this, some of the best practice, some takeaways that we've seen is to ensure that you have a complete list of all leases. Make sure you've captured every lease that's out there, and then most importantly is considering all previously recorded balances, meaning if you have deposits, deferred rent calculations, or liabilities recorded, to ensure that those they're included in the calculations as you determine the values of your right to use asset and the corresponding liability. So because all of those other items will then be captured through the adjustment for the right to use asset. And then lastly, if you're going through and potentially entering into a new material lease, a lease that's very significant, you may want to consider adopting this early instead of having to record the lease in fiscal year 2021 and then 2 years later have to adopt this. You might just want to consider whether you should adopt it at the time of the new lease that's taking place. And I know a lot of organizations with COVID-19 and stuff are going back and reevaluating a lot of their leases, and this might be a good time to go back and potentially implementing this early.
I would agree. Definitely a much cleaner approach if you are renegotiating or starting up a new lease. Get that out of the way.
Right.
One last standard that we wanted to make a comment on was ASU 2019-03, which updates the definition of collections and really creates alignment with the ethics standards and professional practices of the American Alliance of Museums. So for those who have collections or read financial statements of museums and libraries, etc., you'll know that under current GAAP, an entity holding collections such as a museum or a library need not recognize contributions of works of art or historical treasures and similar assets if they are added to collections and meet 3 criteria. And one of those criteria requires the entity to have an organizational policy that requires the proceeds from collection items that are sold to be used to acquire other collection items. And this now has been expanded to align with the American Alliance of Museums professional practices. This has now been expanded to permit the proceeds on sales of collection items to also be used for the direct care of existing collections. So it's a little bit more leeway there to provide for direct care. And it's really important to note that this is an election that museum directorship together with their curatorial staff will make. The accounting is really just going to follow along with management's policy. This is not a dictate of the accounting standards. So be aware of that. And now, for everyone's favorite, the single audit, which is a lot more talked about in the last year than has been perhaps in the past, simply because, so many more federal grants out there. Yulia, remind us, what is the threshold for a single audit and what are the associated deadlines?
I would agree that now with so many entities receiving new and additional federal funding, single audit is definitely a hot topic out there. Just as a refresher, the threshold for the single audit is $750,000 of federal expenditures in a year. So that may come either directly or indirectly as a pass-through from another agency or even a nonprofit organization. And a single audit will include an audit of your financial statements as well as federal awards compliance. Now, the single audit submission due date is the earlier of the 30 calendar days from the date of the receipt of the audit report or 9 months from the year end. And that deadline has actually been extended for all entities who need to complete that single audit and have not done so as of March 19, 2021, up through June 2021 year ends. The extension is for 6 months. It's automatic. You don't need to file anywhere, any application to apply for that. And it's not limited to entities who receive COVID-related funding or that even have been impacted by that, by the pandemic operationally. So it's available to all entities within those states.
And what about recipients of grant funding in 2020 and 2021? What should they be watching out for? Because it's not always that clear when a grant might have a federal component. What are your cautions and suggestions for those that have received grant funding?
That's a great question. With so much new federal funding available under the CARES Act, the American Recovery Plan Act, as well as COVID allocations within the existing grants, it's really important to understand the sources of the funding you receive. So that funding may come, as I said, from a federal agency, from a state agency, or even from a nonprofit organization. And all of that might be subject to a single audit, provided you hit that threshold. Also, carefully consider which of that funding does actually go on your schedule of expenditures of federal awards. For example, a lot of the organizations received Paycheck Protection Program loans, and those are specifically excluded from single audit and would not go on your CFAs. To the contrary, economic disaster injury loans, as well as the provider relief funds, would actually go on your CFAs and would be subject to single audits.
Yeah, and I think that caution, particularly for grants that are being passed through, is an important one. So you might be getting funding from a community foundation or from an association that has itself received funding to pass through under these acts. And so asking the questions of your funding source and of your grantor will be really important. And Mark, for those, well, I want to say unfortunate organizations that have to undergo a single audit, maybe that's the wrong term because obviously they got extra funding. So there's a benefit there, but of course there's a burden on the administrative side. But for those organizations that have to undergo a single audit for the first time, what best practices do you have?
Sure. Well, I think the most important thing that Yulia had pointed out is ensuring that you have a complete and accurate inventory of all your federal grants. both from an understatement perspective as well as things that you believe are federal, but potentially they may not be federal. So making sure that's accurate, because when you submit your reporting package to the Federal Clearinghouse, they will take an inventory of the federal funding, and if you are missing a grant on your CFA, which is the schedule of schedule of expenditures of federal awards, if you're missing a grant, they will require you to go back and reissue that CFA. In addition, that could have an impact on the major program determination that your audit firm has gone through. So it could have an issue where some additional work may be required, but at a minimum, the reissuance of the single audit report would be required. So that's very important. I think Yulia really emphasized that, to really understand the sources of funding coming through and whether it belongs on the CFA or not. And secondly, is to create a detailed draft of the scheduled expenditures of federal awards. This will assist the organization to determine whether there's many different funding sources, whether there's one funding sources, because as a new recipient, it might all be from one funding source. And that would, as a result, you could have what we call a program-specific audit performed instead of a full single audit performed on your organization. It's a lot less work. It doesn't require a full audit of the financial statements. So it's a lot less work. And for organizations that are receiving funding for the first time, it potentially may be an option for you to perform only a program-specific audit. But some other thoughts that we've had as we've gone through and worked with our clients on first time going through a single audit is one, also going back and revisiting your written policies and procedures to ensure that it addresses the federal requirements, allowability of costs, cash management, procurement, subrecipient monitoring. These are items that are a little bit different from the federal guidelines compared to what you may have already implemented. And you need to ensure that your written policies or procedures are in accordance with the federal guidelines, as well as that you've complied with that when you're charging expenses over to a grant, or if you've distributed money out to subrecipients, that you're properly monitoring those subrecipients. These could all result in areas of non-compliance, which could prevent you from receiving funding in the future if you have some substantial findings. Next is making sure that you maintain all your financial records, ensuring that you have proper support behind your allowable expenditures that you've charged to the grants, any type of financial or performance reports that are required to be submitted in, ensuring that you've kept and maintained supporting documentation. That's very important, because not only us as your external auditors, but agencies will come in and audit organizations that received grant funding as well, and will also ask for support. They need to be able to reperform whatever support that you have to support either the allowable expenses or the information that have been included in financial and performance reports. And lastly, we recommend our clients to also perform what we call like a self-audit on compliance, kind of going through and kind of checking to make sure that you really understood the components that were included in your grant agreement, understood the requirements that are embedded into the compliance supplements, to ensure that you don't have any issues with non-compliance. If you do identify something, you're reporting that ahead of time to your granting agency may alleviate some of the issues that may come up if it's found by your auditors or found by the granting agency auditors. And lastly, the last recommendation is make sure you reach out to your CPA firm that you have. Hopefully you've already had these conversations during the planning discussions with your CPA firm, but make sure they're involved as well as you're identifying these grants, so they can prepare and hopefully provide you with some guidance as well as you go through and prepare for the single audit.
Yeah, some great recommendations there. And, GHJ is a member of the Government Audit Quality Center, and we get updates and participate in their webinars as well. And the general concern or sense is that they're going to be a lot more, or first of all, a lot more organizations subject to single audit, and unfortunately a lot more findings, because obviously the funding came quickly, wasn't a lot of time perhaps to ramp up and address all of those items that Mark mentioned that may sound foreign to a few people on the call, subrecipient monitoring, one. etc. So definitely, it's not too late to get that taken care of. So definitely reach out for help in that area. And Mark made a comment about reviewing policies and procedures. And even if you didn't get any funding that's subjecting you to a single audit, we still recommend that you take a look at your existing policies and procedures as a good best practice right now, because many processes and controls will likely have changed as a result of the pandemic. So now is a good time to do an update. We are going to have a second of the three polls is going to come up in a moment. And yes, it's on the screen now. Has your organization implemented the new revenue recognition standard governing contracts with customers? So we'll get to see how many deferred and how many launched right in and adopted it. And now we're going to actually take a break from accounting. I think we've been speaking a lot about accounting, and now we're going to turn over to the tax side for some updates from the IRS and also on various forms. So I'm going to turn it over to Liz.
Thank you, Donella. And I don't know how much more exciting the tax updates are going to be compared to the audit updates, but definitely go through all of them with you today. The first one is in regards to the mandatory e-filing. So this is applicable for the 2020 tax year, where the Taxpayer First Act is actually now requiring tax-exempt organizations to file their Form 990, 990-PF, and 990-T electronically. So you can no longer paper file those returns. There is a delay on organizations that are smaller and file the 990-EZ. They're actually giving them additional time in order to comply with this requirement. But I think that this topic is, I think, one of the key items we wanted to share. The next one is an update on the Form 990 in regards to the Schedule B list of contributors. So this is where we list all of the donor information, the name, addresses, and how much they contributed during the year. And there is a new regulation where non-501c3, so C4s, C6s, which are associations, are actually no longer required to include the donor name and addresses on the Schedule B. They are actually now exempt. So this is a new regulation that passed, and now it's being incorporated within the 2020 instructions. And although you're not providing this information to the IRS, you obviously do need to keep that information in your records of all of the donations you did receive. And for California purposes, you actually still do need to disclose all donors. California does have a requirement where you do need to disclose donors of $5,000 or higher for that year. So just please note that there's that federal exemption, but the California state still requires it. The next one is in regards to the 1098-C filing requirement. So the 1098-C, which some of you may not be familiar with, is a form that you file when you get vehicle donations. So if somebody donates a vehicle to your organization, you're actually required to complete this form that asks various questions, such as, what was the type and model of the vehicle, the VIN number, the value, and so forth. Once the organization prepares this form, you're actually required to provide a copy to the donor, because the donor needs to attach this 1098-C in their individual income tax return. It seems that this is maybe not happening as often. So the IRS has specifically just added this in the instructions to make sure you are providing these 1098-Cs to your donors. And again, this is something you file with the IRS and give to the donor if you receive a vehicle donation. So those are the updates on the Form 990. We do have a couple on the 990-PF, which is the private foundation return. And the most important one is regarding the excise tax rate. So many of you known that the excise tax rate changed to a flat 1.39% for organizations. In the past, you would either qualify for a 1% or 2%, depending on the total distributions you made on a yearly basis. If it was more than your 5-year average, you qualified for that lower rate. So now that's all gone. It's a lot easier now. The 2020 form actually grayed out that section where you would make that calculation, whether you qualified for that lower tax tax rate. I know this does assist a lot of our foundations that tend to plan that year end, whether, they had to give a little bit extra to meet that 1% or not. So definitely save some time in terms of planning and grant making for our private foundations. Another update is on the Form 990T. This is on the unrelated business income form. They did actually revise it. In the past, the actual form was a couple of pages, and now it's only 2 pages with a Schedule A where you're actually going to report your multiple unrelated business incomes. They recently passed a rule where you can no longer combine different unrelated business incomes. So you actually have to silo them, meaning you have to pay tax depending on the different types of businesses you may have. And you can't use one loss to offset the other. So the Form 990T has just been reformatted in order for you to disclose those separate unrelated business incomes in the tax return and pay the different taxes for each of those. I do want to point out that the IRS did issue final regulations on how to determine what's an unrelated business income and how can you combine or separate them. I know a lot of our clients have alternative investments in partnerships, and sometimes these partnerships do spin off unrelated business income. So there is a de minimis rule where if you only hold 2% of the capital within that investment, you can actually aggregate all K1s as one single business. You don't actually have to treat each one as a separate one. And there is also a participation test where they look at whether you own 20% or less. They also look at how much is being held by disqualified individuals. Do you have any control within the partnership? And if you're able to meet certain requirements there, again, you're also able to aggregate it. The good thing is that most of our clients, again, have the unrelated business income through these flow-through partnerships, and we're just able to aggregate it and not file multiple unrelated business incomes for them. And the next item I just want to highlight quickly is regarding excess compensation. So final regulations were also issued regarding this topic, and this is tax that tax exempt organizations actually have to pay if they are paying an individual more than $1 million during a year. They are subject to an excise tax of 21% on any excess amount, as well as any parachute payments. So just wanted to point that out, that there are final regulations on what needs to be captured and included in that. And then lastly, I do want to just add a quick highlight regarding the exempt organization and government entities report. Normally, they issue a report in regards to some of the areas that they're focusing on, what they're going to look into. And one of them are actually data-driven examinations, where they are looking at the boxes and information that's being disclosed on your Form 990, and they're generating IRS audits based on what you're disclosing to them. So for example, let's say you have several conflict related party transactions, but you don't have a conflict of interest policy, things like that, that may be potential red flags. So they're using that to actually generate audits now. So this is something obviously that everyone should be aware of. And, I know as a practice of ours, we always do a review to ensure that, we see if there are any potential red flags that may be disclosed on the Form 990.
IRS has been quite busy in certain areas, right? Perhaps not in processing refunds for individuals, etc.
Yes, that's true. And sorry to interrupt you, Danella. One thing I do actually want to add on to that. I know a lot of organizations are actually still waiting on that employee fringe benefit tax that was repealed, and then amounts were refunded. The IRS is actually starting to audit some of those refunds. It seems there was some fraud where organizations were claiming refunds and they actually never had that fringe benefit. So if you get a notice from the IRS actually asking for additional information, that is actually happening, where they're looking to ensure that you're claiming the refund based on those employee fringe taxes that were claimed.
Adding insult to injury, right? First of all, that was a very frustrating tax in the first place, and now you might be audited as a result.
Yes.
Liz, before we move over and back to the accounting side on revenue recognition, What are some of the top, what are the top 3 questions that you are getting from clients at the moment as you reflect back in the last 6 months or so?
That's a good question. So one of them is actually regarding PTO and accrual and the cash out option. Obviously, COVID was very hard on some individuals, so employers were trying to do their best to assist those individuals, and we're offering cash out options for the PTO accrual. And this is just a warning that you actually have to be very careful on how you're structuring these, because oftentimes if you are offering this cash out option, it may be considered income as it's being accrued, even though you haven't paid it out. You may actually have to report it within the W-2 wages. So a way to get around this is individuals actually need to make an option of how much they want to cash out before the year even starts. And then you would cash it out towards the end of the year. So just if you are thinking of this, work with your HR department, your legal team to ensure that your policy is accurate when putting it together. Another item that I am also getting a lot of questions is regarding stipends. Again, due to COVID, a lot of employers want to offer whatever assistance they can. And one thing or one question keeps coming up is regarding stipends that organizations want to provide to their employees that may now be working remote and are incurring additional cost for internet, equipment, monitors, and so forth. And organizations can actually take advantage of the disaster relief payment under Internal Revenue Code Section 139, where you're allowed to offer stipends to your employees. And this is not considered W-2 wages, so you do not need to include it in their W-2s. And you would offer it to cover these reasonable costs based on the amount you determine. It is not an accountable plan, so individuals do not have to submit receipts and costs in order for you to substantiate it. You would just determine an amount and give them that stipend. And again, I encourage you to take advantage of this because it's a tax-free payment that could be made to some of your employees that may have incurred these costs from working from home.
Liz, before you move on to the 3rd question you're getting from clients, just something quickly popped up in one of the Q&As. What's the code number for that stipend?
Sure. The Internal Revenue Code is yes. IRC Section 139.
IRC Section 139.
Yeah, and it's the disaster relief payment. Mm-hmm. And then next, or another question, or lastly, is out-of-state employees. Again, everybody's starting to work remote, and with remote working comes remote hiring. So a lot of our organizations are looking outside of California to hire individuals and remote workers. So again, a word of caution, some of these individuals may create nexus or a presence within that state. Obviously, it is on a state-by-state basis, but it may actually require the organization to potentially register within the state and some additional filings for that. We, GHJ actually did a webinar where we did a deep dive in regards to this topic. So I do encourage you all to go through it if this is something your organization is contemplating. And we are going to add a link in the chat that you could just follow and save if you're interested in learning more about this topic.
Excellent. Thanks very much, Liz. And we are going to launch another poll, the last poll for those that are wanting their CPE. And as that comes up, I'll just make a comment on our results of our last poll. It seems 50% are still assessing the impact of the revenue recognition standard on their revenue recognition. But 35% have done that analysis, have implemented it, and there was no impact on timing. But 15% did actually see a change in revenue recognition patterns for certain revenue streams. So definitely the sooner you start that assessment or complete that assessment, you probably started some of it last year when you were implementing ASU 2018-08. But now we're going to turn it over to Mark and Yulia on this topic of revenue recognition, which has been a topic for a long time. It's a complex standard. Mark, when we talk about the new revenue recognition standards, what standards are we referencing? Oh, Mark, you're on mute. It had to happen at one point.
Had to happen. I knew it was going to be me as well. So I apologize. For nonprofit organizations, there are two main revenue recognition standards. The first, of course, is ASU 2018-08 related to contribution accounting. The second is Topic 606, which is revenue from contracts with customers. There are some revenue streams that have been carved out of these two standards. Topic 842 was one that I spoke about earlier, but these are the two main standards for nonprofit revenue recognition. And I know we're all familiar with ASU 2018-08, so we're going to focus on a little bit more on Topic 606. And as Donella has mentioned, over 50% of the participants are currently still evaluating Topic 606 and the impact on your organization. And both ASU 2018-08 and 606, as organizations were going through the three-step process of evaluating their revenue streams, the first step, required organizations to go through and identify whether the revenue stream has any commensurate value being received by both parties, meaning that both parties are receiving some type of value from that transaction. And if it did, then if there is commensurate value from both parties, Topic 606 would be required to be followed. If they didn't, ASU 2018-08 would be followed. And steps 2 and 3 relate to ASU 2018-08. But under Topic 606, there is a 5-step process that's required under this new guidance. And some of the more important aspects that as we've seen our clients go through and evaluate the 606 5-step evaluation process, some of the key considerations they're going through and spending a little bit more time on is ensuring that they identify, understand all performance obligations within the agreements and identifying each of those performance obligations. And then really understanding when do these performance obligations, when are they satisfied? Are they over time or at a point in time? And that really will impact the revenue recognition and the timing of that recognition. And these are the two areas that I think most of our clients went through and implemented Topic 606, really struggled with them and ensured and spent more time to ensure that they really identified all the obligations and what period of time does it get satisfied.
Thank you, Mark. And Yulia, maybe you can put it into context for us too, now that we've gone through a little bit more of the theory and a reminder of that. Could you take us through an example of a nonprofit revenue stream that would fall under ASC 606?
Sure, of course. There's plenty of revenue streams that would actually fall under this standard. Sometimes even revenue streams that we commonly think of as contributions actually have an exchange element in them. Sometimes even if you think about the sponsorship received for a special event, usually when the donor pays a sponsorship fee, there is an exchange element. The donor receives a meal, entertainment at the event, and that technically that portion of revenue should be segregated and accounted for under the ASC 606. In practice, however, most nonprofits believe that this value received by the donor is incidental to the benefit received by the organization to support its activities. Another common revenue stream where the other party commonly receives commensurate value is memberships in an association or membership organization. Now, the contract here is to provide membership benefits over a certain period of time, usually a year, for a fee. And when you think about the performance obligations here, you can define it broadly as providing member services. But usually there are 3 or 4 things that members receive as part of that membership. For example, getting discounted access to events, getting access to networking opportunities, getting access to publications, pushed out by the membership association. So technically, you should be going through and allocating the transaction price among those performance obligations. In practice, again, with member benefits being provided over the term of the year, if they are provided ratably over the term of the year for all performance obligations, revenue would also be ratably and consistently recognized during the year, whether or not you choose to go through the exercise of allocating that transaction price among the performance obligations. Now, contrast this to the membership in a museum, where members usually do receive certain benefits. However, most museums approach or deem those membership fees received as being contributions, as the value received by the members is incidental to supporting the museum's activities that are available to the general public.
Thank you, Yulia. And turning to some of the disclosure requirements, because I know they're quite burdensome in the standard, what are you seeing out in practice in the industry, looking across all sorts of different financial statements that have been issued by nonprofit organizations who've implemented the standard? What do you see emerging?
Definitely, the standard does require a significant detailed information disclosed in relation to the revenue streams. And we have done a lot of research looking at other nonprofit organizations throughout the country, seeing what they are disclosing. And what we've noticed is sometimes nonprofits choose to disclose that required information on the face of the statement of activities and statement of financial position, such as your different types of revenues, and providing pretty detailed information there, and then including some of that information on how the performance obligations are satisfied in the policy notes, as well as some other required information. And so as a result, when you have all that sufficient detail on the face of the financial statements and in the policy notes, you may choose to omit the additional disclosures that provide the tabular information about pretty much the same information, just summarized in a different way.
I like the sound of that. So as long as you've got sufficient detail in your statement of activities, separating out, maybe add in some extra line items this year in your financials, and you have some more detailed policy descriptions, you may not need to have all of that detail in the footnotes at a point in time, over time, which frankly is not that useful, I think, having looked at some of them so far. So I do like that practical interpretation that is emerging. And, one final comment, because we're actually almost at the hour. We wanted to make one last comment. And I see, Mary, you've been very active with your questions in the Q&A. We'll answer them. I think we'll answer them offline. And Bonnie as well, we'll address your questions. But just one final comment really related to cybersecurity. And, in this age of remote working and digital transformation, we wanted to share our top 3 recommendations we have for strengthening IT controls, information technology controls. So number 1, educate your employees and keep educating them. Keep them aware of phishing scams, etc. Keep them alert to emails that may be sending them in the wrong direction. You don't want to end up with any wire transfers going out the door without appropriate approvals. Employee alertness really is the first line of defense when it comes to maintaining cybersecurity. Also perform regular updates to all computers and servers to ensure that all those security updates and fixes are current. That's number 2. And then number 3, don't forget, because we've seen a lot of this not happening, implement that multi-factor authentication, that second means of identification, and or the single sign-on for sensitive systems, and implement stricter password requirements on everything else. The lengthier and more complex the password, the more challenging it is to crack, of course, as we all know. But those are 3 takeaways, 3 reminders as we continue to work in this remote world, maybe going back to a hybrid form soon. And our time is now up. And for those who raised questions in the chat, as I mentioned, we will respond to them. And of course, if you have anyone else in the call has other questions, feel free to email us directly and we'll be happy to answer your questions. Our contact information will be in the email you will receive with the recording after the webinar. Thank you very much for joining us today, and thank you to my wonderful panelists, Mark, Yulia, and Liz, and enjoy the rest of your afternoon, everyone.